you all for joining. We have with us today Mr. Sunil Subramaniam. He's the Managing Director of Sundaram Asset Management. Sunil is also on the Board of Directors of Sundaram Asset Management Singapore. He has over 3 decades of work experience in the financial services sector across MNCs, public and private sector companies. He's worked with SBI, American Express Bank, and Bank of America. In his tenure at Sundaram over the last 15 years, he's handled various responsibilities through which he's instrumental in expanding Sundaram Mutual's footprint, both domestically and internationally. During the time with Sundaram Mutual Fund, the AUM has seen a manifold growth. Sunil has also been recognized by the Economic Times as one of the most promising business leaders of Asia for 5 years in a row. He's also been recognized by CNBC TV18 and Asia One under India's Greatest Brands and Leaders 2021. I know he's also into fitness, and I'm sure he's covered a huge amount of steps by 11 o'clock this morning. Thank you for joining us, Mr. Subramaniam. I'll hand over to Amitabh and Sunil now. Thank you.
Thank you. Are you able to hear me? Just want to check the audio.
Yes, we can. Yes, we can hear you loud and clear. So great to see you here, Sunil. And of course, we are privileged to have you. A lot of people on this call are keen to hear you and your views. There's a lot happening. We thought the market is going down. The market started going up. So when we set out this talk, and if you remember a month or so back, we were talking of volatility, and that's why we took the topic as volatility, and how so true it has been in this phase, especially when you think it's going one direction and it is going the other way. So we are very, very keen to hear from you. And if you want to have any opening comments, and then I have a series of questions which we have for you and many more in the Q&A session. But if you have any opening comments, then over to you, and then we'll get on with the chat.
I just want to recollect the Chinese proverb, right? Which says, may you live in interesting times. So I think today, I think that's what is panning out. And I think that is the challenge for an investor, an advisor, and a manufacturer, right? Is how do you navigate? Because we are aware that investing is essentially handled as a logical, rational process. But we know that human beings at the back of it operate from an emotional perspective. So you have heard that the fear and greed factor comes in. There are many articles which are actually titled as a fear and greed. So I think navigating the emotional space that stock market participants are doing is, I think, the biggest challenge in front of us. And that will explain a lot of what I'm sure when you come to the Q&A and we talk about your questions, right? The running thread will be that there is a balance between the fear and the greed factor, and one needs to be cognizant of that in terms of our own actions. I think that's the opening statement I'd like to make.
Fair, and I think that's profound, because fear and greed is what drives a lot of actions. So while we can go on to the market, but before we do that, let's start with an area where you're well qualified to speak on, and given what you do, which is about the India opportunity. And in terms of what is the wealth creation which you think which could happen over the next decade, and how do you quantify, see, think through of the India opportunity?
So first of all, I would like to take this to basic biology. Okay, in zoology, to be more specific, they say that you plant a seed, and and then the root comes, and the stem comes, and the branches, the leaves, and finally the fruits come, right? So India today is in a position where, and when the seed is planted, it makes a big difference whether it's planted in the shade or it's planted in the sunlight. Because as you know, sunlight fosters growth, and trees which are planted in the shade. Some of them snake their way up to reach the sunlight somehow, but those who are planted in the sunshine, they tend. So why I'm pointing this out is, first is there is an action of our own self, which is planting the seed, right? The second is that there's an environment around it, which is one of sunlight, right? Now, taking this parallel to India, right? I think that for us, the seed that was planted was actually a seed which was not wanting to be planted. So let me explain why I say this. Because years ago, and then I'm talking about the late 70s and the early 80s, right? There was this fear that India, as a poor nation, as it was then, right? Maybe LDC, least developed country, you may call it, was worried that there were too many mouths to feed and our income generating capacity as a nation was not going to cope. So there was this great feeling that we have to control population. Family planning was the mantra, and if you recollect, then Sanjay Gandhi, who was the son of Indira Gandhi, made a major campaign around family planning. There was some forcible neutralizations done, and in fact that lost them on election also. But the key is that we tried not to plant the seed. We tried to control our population, and we failed in that. And that today has proved to be our biggest benefit. The fact that today, because we didn't control our population, we have today the youngest population in the world. We have the fastest growing youth population in the world, and the related advantages. So this is as far as the seed is concerned. So the seed was planted in our failure to control our population. Let me put it that way. The environment I talked about, right? Now, the sunlight part, right? Now, what happened is that another country which was exactly in the similar space as India, which was then the most populous country in the world, China, right? In the initial stages of the decades, that is 1980s we talked about, but well, at least 20 years into that, they did not control their population. But what they did was they used the opportunity by bidding for the Olympics in 2008, right? The Beijing Olympics. And around 2002, they started the work to make the country capable of hosting a Summer Olympics, and then followed with the Winter Olympics also later. So they built stadiums, they built swimming pools, they built airports, they built intercity highways to make sure that as a vast country, they could actually successfully carry out. But there was a very, very ulterior motive, I mean, say that this was just an excuse for them to make sure they get their whole infra act in order, because they looked at their population as an advantage at that stage and said, how can we get global manufacturing into our country? We can get that only if the infrastructure means that vastness of the country doesn't matter, because any manufacturer coming in, obviously they said that we have supply of labor and we have a cost of labor will be cheap. But more importantly, you need to make sure that near the raw material, the factory will be set up. But in the port, the products will be shipped out. So from the factory to the port, how fast can the product go is a critical factor when a manufacturer comes in. So this conscious effort around the background of the Olympics to build their infrastructure meant that once the Olympics got over, and then they pushed manufacturing through various incentives and everything, China very quickly became the manufacturing capital of the world. And they grew to the extent that they control almost 15% of the world's exports single-handedly, manufactured exports. And their growth led to strong double-digit GDP growth for an extended period of time. And today, when China is slowing down, it's at 4.5%. A 4.5% GDP growth is considered a slowdown in China. So the point where I'm saying is this, and then the Act of Commission came in. China themselves realized that, oh, we have expanded it so much, and can we now sustain? So around 2016, I think, or maybe 2011, I think, right? They started to think that we can't keep pace of the growth with our population, and they started doing family planning in right earnest through this one family, one child policy, right? So what happened is, paradoxically, a nation which had taken advantage of the labor explosion of infrastructure development started actually controlling the growth of their population. And so from 2017 onwards, China's working age population has started to decrease because there is not enough babies being produced to fill the working gap. So China's working age population from the year 2017 has started to decrease, number one. Number two is the success of their manufacturing come export efforts meant that their per capita GDP went up from 2002, it was around $2,000 to today's $13,000. So they 6x they multiplied their per capita income. Naturally, that meant there was a consumption boom also. But the manufacturing cost also has gone up almost by 5 to 6 times. So then what is this? Since 2017, China has got into this structural dilemma now that they are losing their labor is going because older people as they retire, the workforce is not getting replenished. So they are losing quantity of labor and their products are becoming more expensive because if you take 5x, maybe they started with mobile phone assembly. Somebody would, let's say, charge $10 per hour. Same labor is today charging $50 per hour. So the cost competitiveness got affected, right? So this situation, and then for India, right, the population was going on increasing. But then what happened was COVID came. And COVID, while it was bad news for most of the world, was good news for India. So there is another aspect where it's good news because we became the suppliers of the vaccine. We got a lot of PR. We did all that. But the point is that COVID also damaged China's perception in the eyes of the Western world because everybody felt they had not done enough to control COVID. And then started the process of people saying, oh God, I can't depend on China as a manufacturing destination. I need a China plus one. Now, nobody is saying stop from China, but it is China plus one. So this is the genesis of the China plus one. Now, who can take advantage of this plus one? There are two aspects to it. Supply of labor, cost of labor. In supply of labor, India is streaks ahead of the rest of the world, right? 22% of the addition to the world's working force is going to come from India over the next decade. Means 1 in every 5 laborers is born in India, number one. Number two is cost. And at cost today, compared to China, China is about $4 per hour. We are $1.6 per hour manufacturing wage. So we are cheap, but Vietnam is also at 1.6. So India and Vietnam together are the most manufacturing labor-wise cost competitive. So India's growth opportunity then is based on this, right? A, the seed we did not plant on family planning, and B, the fact that China taught us how to do this and then went through that cycle and came to the down cycle. So we are today ideally positioned to become the next China for the world. But then we need to get the infrastructure in place, right? As China did. So now for us, we just have to follow the Chinese path. We may not achieve it the same pace as China because we are a democracy and we are an elephantine democracy. So elephants move slowly, but they move decisively, right? So we may be slower in growth than China. You can't replicate the pace of growth, but what they took probably a decade, we may take 2 decades. But it means that for 2 decades, India's growth story, as long as the governments in power focus on infrastructure and on labor generating. So all the schemes of the government in terms of the PLI scheme, which is inviting foreign exporters, all are geared to take. So the crux of India's opportunity lies around this. And the headline word that they use for this is called demographic dividend. You'll use a lot of jargon in the financial world. That's one of our problems with with all of us, right? But simply speaking, this in summary is the basis of India's opportunity and the fact that we have a government in place which recognizes this and has put all its efforts around the infrastructure program, right? I hope that gives you the fundamental basis for our growth.
Yes. So what I'm hearing from you is that possibly, and in many of our discussions, I've been saying that this decade is India's. Possibly what I heard from you that maybe the next couple of decades could be an area where this growth could play out. And that's a huge positive for us. And as you said, China has moved from a per capita income of $2,000 to $12,000, $13,000. We are at two and a half, somewhere around there. And even if we can go to $5,000, $6,000 over the next few years, that would make a huge difference to the entire A market, individuals' lifestyles, and what gets consumed and what gets used. So I think it's a massive opportunity. And just to break that down a little bit further, uh, what you talked about was the manufacturing side of the bit. Early stages of India growth was on the services side, not so much on the manufacturing side. If you look at the first phase of India growth, so how do you look at India? You said India has to follow the China's model of manufacturing. Do you think that India should also and can also take advantages of the services side where it held early lead or it started off well? And so how do you look at the opportunity from the lens of services as well as manufacturing?
Yes. So China did not grow in the area of services because the British never ruled China. Because the British ruled India, what they gave us was the knowledge of the English language and a very good educational system. So how much ever we might criticize the British for they looting our country and all that, blah, blah, blah. You hear, the fact is, as a byproduct of their rule of the country, we have a very solid English speaking. So which means that in services, communicating, a call center starts the basic of that, is why India's that one. And the education system meant that we had very good scientific education, whether it's in engineering, which became software engineers, or it's in pharma, where they became PhDs. So India's services growth has on the background of a combination of the English language and a solid foundational educational system. Now, the fact of the matter is that for the future growth, it is not an either or. And I explain this for 2-3 reasons. Is that Indians, those who are doing manufacturing, are essentially blue-collar workers at the bottom. So as India's population grows, not everybody has access to English language education, everything. So the manufacturing is going to get catered by the blue-collar segment, which is into technical educations, and provide that. And on top of that, India produces the largest number of engineers in the world, right? So that's step one. Step two is that the educated people would still work only in the services sector. So if you see then from what people would like to work in, right, it is going to be a combination of manufacturing and services. That's number one. Number two is, even within services, what has happened is that we have now moved from simple IT and IT-enabled services like call center and outsourcing to what is called as the professional services exports, right? The global knowledge centers are all coming to India. So the new phase of growth is in professional services exports, right? Which is not just English knowledge, but it's in value-added thing. That's one. Second thing is that in the manufacturing space, there's a study which has shown that for every one job that gets created in the manufacturing sector, 1.8 jobs get created in the services sector. Because right from the car which needs to get transport him, to the canteen which needs to supply him, to the shopping firms, to the labor shopping firms which come in to support. So you have a whole diaspora of things which come in. And third and final thing is that manufacturing leads to an increase in per capita income. Per capita income will lead to an increase in expenditure, which is consumption. And to support consumption, you need a whole lot of services to come in. So when we say manufacturing is going to grow fast, it means that services is probably not going to be dominant in terms of the growth in India, but it doesn't mean that it's going to falter, because it will grow at its own pace of growth. The reason manufacturing as a share of GDP may gain a few percentage points over this is because it's part of a larger pie. So it's not that there's one is growth and one is degrowth. It is that one is growing at a very faster pace. Another will continue its growth at its own double-digit pace. What will probably suffer is agriculture in its contribution, because as the higher revenue generating opportunities for people come up in both manufacturing services, labor shortage would probably come into agriculture, and that would drive mechanization and other productivity in the agri sector. But overall, the contribution of agri to our overall GDP would probably trend down in that sort as a part of the pie, because it also is the slowest growing sector in terms of contribution to GDP, right? So I see services and manufacturing going hand in hand, in terms of taking forward India's story. In fact, even today, India's export share, if you see, is overall 1.9%. China's is at 14-15%. But of which services is already at 4.5-5%. Manufacturing is only at 0.1 or 0.9 or something like that. So I think that India is a story of both manufacturing and services as two horses driving this chariot of growth.
Fair. So now we'll change gears a bit. Because clearly the backdrop is laid that there are 2 decades of growth. There is services and manufacturing, and the sunshine is shining. There may be some rain here and there, but the broad outlook is good. So let's move straight to the markets, which is what most people on this call are keen to know about in terms of what's your take on the market? What's short? Break it down to short, medium, long term, as well as what are the risk factors? So straight on the market.
So on the market, first people need to understand that the stock market is a commodity. Okay. So why do I make this parallel? Is that as a commodity, if you take any commodity like oil or gold or rice or potato, or except gold, I would say, leave gold out of the picture. Every commodity has a certain manufacturing cost, which one would expect to get covered, including the profit manager of the manufacturer, right? Right? But the price that the commodity gets in the marketplace is not a function of that manufacturer's inputs and the cost involved. Very often you see potatoes trading at 2 rupees per kilo, all the way up to 40 rupees per kilo. Tomatoes is the most recent story when you saw that. Because demand and supply for that commodity alters the dynamic. And sometimes it means that even the manufacturing cost doesn't get covered. So you hear of farmer suicides because their basic cost of production also has not been recovered from the market. So the stock market as a whole is also a commodity. So what is the manufacturing equivalent here? It is the EPS growth of the stock market companies, which comes from the economic growth. And all that we spoke about over the last 5-10 minutes was that long-term future of economic growth is assured. So, and good, healthy EPS growth of the stock market is also assured. But will the market pay the price of that EPS is a function of demand and supply for the stocks, right? So your question on short, medium term, long term arises on, is there going to be adequate demand for the stock market in the short term, medium term and long term? Now, when you analyze the demand, only then you will know that there is a point in time when demand exceeds supply and then the prices go crazy. And that's when valuations are very expensive. And there is a time when the opposite happens. That is, economic growth will be good, EPS growth will be good, but there are no buyers for the stock market. Now, why would that happen? Because remember, money flows wherever. Like you would have heard in your science lessons, right? Water finds its own level. Water finds the best level. Like that, liquidity or money also finds its own level. So as long as the stock market opportunity is looking better than other opportunities for an investor, it will deliver the value proposition that represents the EPS growth. If it doesn't, if there are other avenues for the investor which are providing better returns, money will flow there and the stock market will suffer regardless of whether it is doing well or not. So the point is, and then so where does this demand come from? Broadly put it, there's a domestic demand and there's an overseas demand. Okay. And in the Indian market, the domestic demand is split between domestic mutual funds who are buyers, insurance companies who are buyers, the retail investors who trade and buy in the stock market, and your portfolio management, AIF, and those kind of things which are buying. These are all the composition of buyers, but you notice that each of these is backed by hundreds and thousands of retail investors putting their money into these, right? So essentially, domestic buying comes when a domestic investor on the street feels the stock market is a worthy investment. And what is this comparison framework? It's a bank deposit or a post office savings scheme. While advisors try to talk to them about inflation, actually really a customer does not associate that inflation so much. He associates only with the alternative, completely government guaranteed bank deposit assured return scheme. So for him, if that's an opportunity and if the stock market looks promising enough to deliver better than that, he will pour money into the insurance, into mutual funds, into AIFs, PMFs, whatever, and they will in turn buy in the market, right? So that's the domestic story. Second is the FII story. Now, the FII story is that it's like this, right? If you take the total ownership of FIIs of Indian stock market, it's about 16%. But this is a misleading number because 42% of the stock market is owned by the promoters of the companies. Now, that stock is not available for sale. It's locked up in the lockers. The owner will not going to part with his ownership. So if you knock on that 42%, you're left with 58%, which broadly correlates with what is called the free float market cap of the country. In the free float market cap, FIs own 35%. Mutual funds own about 15-16, retail owns about 15-16, insurance owns about 10. The rest of it is all spread. And as I said, it is on the women fancy of hundreds and thousands of retail investors giving money to them. Because if an insurance company or a mutual fund or an AIF gets money from the customer, they have to 95% of that money, they have to invest it. They can take a 5% cash call, maybe 10% in some cases. So the buying by domestic is at the control of a large mass of population who are basically intuitively looking and saying, is India's economic growth looking good? Is the stock market going to give me a better return than the bank deposit? And then put money into the market, right? So it's very hard to predict, judge in the short term what will happen. But for India right now, what has happened luckily is that over the last 1 year and then the year before that, last 1 year itself, there's been a 30% growth in what is called as the SIP book. The SIP book is hundreds of thousands of people putting monthly money. That has become about the order of 17,000 crores. So what this then gives a feeling to domestic fund managers is that I have a certainty of flow because most of these SIPs, 65% plus, are for 5 years and plus. So domestic fund managers know that I'm going to get money every month. So they know that they have to be buying and they're looking for opportunities to buy. So the first is broadly from a domestic perspective, the buying strength is going to continue because of this change in the nature of the dynamic for domestic stock markets, and the SIP book has become a significant part of the flows into the market, right? So from a short term, medium term, long term, this domestic flow of money is going to act as what I may call as a shock absorber. Because these people, given how India's GDP data, GST collections are published in the domain, given how bank deposits are hovering at 7 to 8%, and then post-tax, you're looking at a 5 to 6%. For stock markets to promise to beat a 5 to 6% post-tax return, all the stock market needs to deliver is 7%, because with the 10% taxation, you will still get 6.3. So the bar for a stock market to beat for a retail investor is not very high today, because the 7% return will give you 6.3, which is far better, which is probably 30 to 40% higher than a post-tax bank deposit would deliver to you, right? So to that extent, I think for the short, medium and long term, from a domestic perspective, this money in the short term will act as a shock absorber, and the medium and long term will act as a wealth creating force, right? And if you look at it from a slightly longer term perspective, sticking to the domestic part, right, from a medium term, long term perspective, the manufacturing cycle we talked about and the employment generation will happen, which means per capita income, and as you mentioned, if by the end of the decade we double it. Now, what happens is that you got to remember that a person, if you go by the Maslow's theory of, there's a pyramidal structure, right? First, they look after their basic sustainable needs. But as their income goes, their expenditure doesn't need to, a guy can't eat, he can eat 1 kilo of atta a month, but his income doubles, he's not going to eat 2 kilos of atta a month. So his basic consumption of basic commodities, as a proportion of his income comes down. What does he do with that? He buys aspirational goods. So that's where the consumption cycle gets a boost. But beyond that, how many cars can a guy buy? How many houses can a guy buy? How many refrigerators can he buy? So when he reaches a threshold that he's bought all the luxurious, not necessities, but luxurious aspirations, the rest of it goes into savings. And that savings is where the stock market. So in a long term, medium to long term, this, because today also mutual fund penetration is a fraction of the GDP of the country, is a fraction of the household, of the financial assets of the country. And it's improved, but it's hardly 20% of the bank deposits of the country. It was 14%, it's 20%. So bank deposits are 5 times. So the scope for an increased per capita income leading to increased personal disposable income, where the opportunity will then seek the best return possibilities, right, means that the stock market over the medium to long term is assured of a consistent flow from the domestic space of buying for stock market related shares and stocks, right? So domestically, short-term shock absorber, long-term wealth creator. Now let's look at the international part, because they are 35%. And here it's not decision making is not spread across hundreds and thousands of people. They may be investing in their mutual funds. The foreign mutual funds put in India may have at the back, but there are a few fund managers deciding. So if you now look at the foreign pie, right, there's essentially three categories of the foreign pie. There is a long-term capital, which comes from sovereign wealth funds of countries like Abu Dhabi Investment Authority, Norwegian Investment Authority. And second is a pension fund, like the California Pension Fund, a Canadian pension fund. So these people are looking at markets over a decade to see where can I get the growth, because I need to meet the pension liability. I need to meet the social security liability of my country, right, by the superior growth. So they seek long-term growth opportunities, and India is ideally positioned. So India is also assured, how much is this? From what I last read, about $700 billion is the FII investment in India. And a quarter of this is from long-term sources. So from a long-term perspective, as India's growth continues, and in fact, in a slowdown in the world, India's share of global GDP is slated to grow from its current 3% levels to 4% in just 4-5 years' time. So these long-term FII investors look at share of global GDP of the country to allocate how much of my money goes to that country. So India is going to grow from 3 to 4. That's a 33% increase in their allocation over the next 3 to 4 years. So long-term money, and bear in mind, long-term money doesn't mean it comes in the long term. Long-term money comes in the short term with a view of a long-term investment. So this is a flow which is will keep coming right through as India demonstrates. And the latest GDP number has only strengthened that India, in a world slowing down, India is growing faster than expected.
Yeah, 7.6% was a surprise, was a positive surprise.
Yes. Second aspect of the foreign money is that there is what I would call as within the mutual fund space, right? There's passive money and active money, right? And abroad, a lot of money has been shifting to passives. Now, what happens is that in the passives, right, hundreds and thousands of investors all over the world put their money into what is called as ETFs, right? Emerging market ETFs. Now, there the story for India has been that 10 years ago, then 5 years ago and today, India was 6% of the emerging market index. Okay. 5 years ago, they were 8% of the index. Today, we are 16% of the index. So which means for every rupee that comes to an emerging market, India, 16 paise comes to India. So this flow, and over the last 3 years, passive flows have dominated active flows in the world at large, because outside India, the active industry hasn't done so well compared to the passives industry. So people have put more faith in passives. And so that flow of money, right, because India's share of the index is just going up. Even this month, it went up by 1 percentage points because of India's growth potential and all. So that passive flow with India's trend, and who are we growing at the cost of? Going cost of China, because China is losing share in the emerging market index, right? So the growth potential of China versus India is translating into a higher emerging market index share, which means that automatically Indian markets get a higher allocation from the passive money that comes, right?
And that's if Korea moves to the developed markets, then India's share would go up more. We'll leave that to a later date, but yes, but what you're saying is right. The share can continue to go up.
Correct. The third aspect, and this is where, these two, I don't expect them, because in a world which is slowing down, liquidity will be ample. All the world, the big governments of the world will promote through their central bankers for quantitative easing, because they want to revive their economy, but liquidity finds its own level. So people will have more money, more liquidity in a downturn, because the governments are pumping more money. Interest rates will be soft, in that scenario. So the flow of money into emerging market equities itself should be strong, and India with its share growing should be strong. So again, over a medium term, I expect this flows to also come and support our capital market growth story. But there's a third element here, which is what causes our volatility, and which is where the domestic flows act as a shock absorber. What is that? This is the active mutual funds and hedge funds, right? Now, the active mutual funds and hedge funds, what they do is they have the benchmark of the emerging market index, but they take their overweight, underweight call based on their view of India. Now, overall, the active mutual funds from an India perspective today have a strong overweight. In fact, next to Japan, I think I took a global survey of fund managers, had 28% overweight on India. Japan was much higher because the market is after sleeping like Kumbhakaran for a long time, has woken up in Japan. But So India is 28% overweight. So which means that active mutual fund managers who take much longer term call, 5 years, 3 to 5 years, are also allocating more money to India than the index. And these are a few fund managers who are taking that decision, right? So India's growth story means that these people will also continue to allocate more money to India. But there is a super active MF, which is also called as hedge fund, right? Now, a hedge fund is the one of the things where Ram has been named as Ravan, right? Why I'm saying this is, a hedge is supposed to protect, but a hedge fund uses protection instruments to actually speculate. So unfortunately, it's one of those most misnamed things in the world of financial thing. It's a hedge fund. Hedge fund is the most speculative. You should quickly change the name to speculative fund. Okay, but that being it, what happens to a hedge fund? Hedge fund is like a margin trader. What they do, they collect money from high risk, comfortable HNIs and institutions, and they bet on markets, right? And this bet is on the back of 2-3 things, right? One is their leverage. So if they collect 20 rupees, they go and borrow 80 rupees from a bank and invest 100 rupees in the market of their choice. So what I mean here is, so they are hoping that because then a 1% return will translate into a 7% return because it's got a multiplier effect because 4x of that, right? So that they bet on that one. Second, what they do is, inevitably, since they're going cross country, they not only bet on the market of their choice, they also bet on currency. Because between two countries, currencies can add to their returns or detract from their returns. Because generally speaking, when they are operating from their advanced countries into emerging countries, currency should weaken. So there's a certain amount of fundamental depreciation which they factor in. But anything in the investment horizon which is more depreciation than expected means they'll get more loss than expected. Less depreciation means they may actually make a gain. So they try to predict the currency movement in the period of the investment. That's the second point. Third point is that they have very short-term outlooks. They go as month as, sometimes they take a 1 week or 1 month or all the way up to 18 months. So they act. And finally, they also have the ability and the willingness to short a market which they feel is going to go down. So what they do is they are taking huge high risk, high reward bets, which their investors are comfortable with because the promise that the rewards will be worth it in the long run. And if they see something bad going, they actually short the market to protect themselves, right? But this action is what then leads to tremendous volatility in the markets they choose, right? And for India, because India is already among the top 5 most sensitive markets to foreign flows, right? In the world, if you see among the top 5 markets who are very sensitive to foreign flows, India is in the top 5. We are 4th rank currently. But the key element here is, for India, there is a one differentiating factor within the emerging market pack, which puts India at one extreme and many others at the other extreme, which is our huge dependency on imported oil. And as a growing economy, oil demand keeps growing. 83% of India's requirement of oil we are importing from the world. So which means what? When oil prices seem to be in a rising trend, these hedge funds will short India or pull out their existing investment from India. But if oil prices are declining, they'll pump more money into India. So this is a very short-term view, but they have to take it accurately. So hedge funds cause volatility in the short term based on an oil approach as far as India is concerned. So if you saw now, in the months of September and October, the OPEC, which controls the price of oil to the extent it can be controlled, announced that there's going to be a big production cut coming this quarter, especially on top of winter heating demand for oil in the world, right? So what happened? When they announced the production cut, everybody anticipated oil started rising. September, October, FIs pulled out 35,000 crores from Indian market. And this 35,000 crores is a net outflow. I suspect that hedge funds would have pulled out 75,000 crores and long-term FIs would have continued investing 30,000 crores. So the net outflow was actually 35,000 crores. But there was 70,000 crores of selling by the hedge funds when oil price seemed to rise. When come November, what happened? US lifted sanctions on Venezuela. So immediately Venezuelan supply came in and these OPEC guys got caught on the wrong foot and oil price started declining. Contra. So once the hedge fund sensed that this was happening, November month, they are again coming back into the market with 10, 15, 20,000 crores into the market. So this short-term volatility is essentially linked to the price of oil. So if you ask me for what is the short-term outlook, I can't give you outlook until I keep looking at the oil price. And tomorrow, if there is some other factor which comes and disrupts oil, you could see outflow or something else which comes and more supply comes. Like latest news is that Brazil is going to join OPEC. Now, if Brazil joins OPEC, then OPEC's hold over the oil market goes up. So maybe, and there's an OPEC meeting slated very shortly, where if they agree to more production, African countries are objecting to that production cut. But if they are forced to fall in line with Saudi Arabia, then again, a production cut would mean oil price could rise. So it is important to track the futures price of oil to decide the amount of volatility caused by hedge funds outside India. But like I said, for us, luckily, there is these domestic flows which are acting as a shock absorber. So the extent of volatility will be limited by the SIP book that we have. I'm sorry, I gave a very detailed and long explanation.
No, very interesting. Very interesting, because what I'm hearing is that in the short term, there will be volatility linked to the oil price. But in the medium to long term, there is a lot of positive factors which are supporting the market and will help the market. So unless one has a very short-term horizon, one should just simply ride these volatilities and get on with it, because the medium-term outlook is looking very, very strong. We can endlessly debate this, but I'm cognizant there are lots of questions which are pouring in, which we have. So one last question I have for you, before we get into specific questions which are there, which are coming from the audience, is if you would want to take very quickly in 1 or 2 minutes from a Sundaram perspective, where there's an audience of our clients, where do you think we could look at, and what are the key strengths which we should focus and do that, and then we'll go to the Q&A.
Okay. So first, overarching, Sundaram's expertise is in the middle small cap segment. Okay. That's where we have a bunch of professionals who have invested in researching the market, doing that. Our mid-cap fund, which is about 9,000 crores in size today, since launched from 2002, has delivered a 23% CAGR, which means 10 rupees has gone 90 times up, right? So mid-cap, India is the home of mid-caps. India's story is the story of mid-caps. So I would say that from a medium to long-term perspective, our mid-cap fund, because it is research-backed based on sound formula, should be a part of a long-term part of anybody's portfolio, because we have a 20-year demonstrated track record, right? It will go through its ups and downs because market always doesn't respect growth and quality. There are momentum plays which come in, but written all of that over 20 years and still delivered a 23% CAGR. So I would like, from a longer-term perspective, that mid-cap is our strength as a core, purely because of the fundamental research we apply and do into that. That's one. The second aspect I would say is that, as I said, manufacturing and services are the two growth segments of the economy. So we happen to have, with a 5-year track record, the only services-oriented fund in the entire mutual fund space. So again, our research have thrown up this, and I will just summarize in just one line. What is the story of the growth of that fund? 5 years back when we launched it, the thesis behind it was very simple. We said that the economy, the services sector has a 54% share of our GDP. And that time, in the index stock market, services was only 36% of the stock market. Why? Because lots of the services sector are in the informal sector, are too small to be listed and all that. But over the last 5 years, as we anticipated, the whole Jan Dhan Aadhaar mobile movement, the direct benefit transfer to bank account, the digital investment in digital infrastructure, the rapid growth of digital, all of that has meant that a huge amount of services-related companies have now grown big enough to get listed into the stock market. So that process which started meant in those 5 years, this 36% share has gone to 40 today, whereas the services sector contribution to the economy remains at 54. This 4% change has led to a 20% CAGR of that fund over the last 5 years. Right? And what is the way forward? The way forward is from 40 to 54. And why do we believe this will happen? Because India has 100 unicorns, of which only 7 or 8 are today listed in the stock market. A unicorn gets a status of $1 billion market cap because private equity has invested, venture capital has invested. But the only way they make their money by listing that company into the stock market. So the largest additions to the stock market over the next decade are going to be from the services sector, from these unicorns, which some of them will succeed, some will not, but they are the ones who are going to come into the capital market. Hence, the growth of services as a component of the stock market is slated to grow. And even if 54 of economy goes to 52 or 50 because manufacturing is going to take a larger share, right? This 36 to 40, 40 to 42, 44 is going to continue to deliver returns to the investor. So fundamentally, that's the driving factor behind this fund. So I would say, since it's a unique fund, right, I would say you can, take a look at it. And it's got a 5-year track record today. So it's something I'm talking about from an experience of having managed that fund over the period. That is something that you can look at from an allocation perspective. And for the manufacturing piece, we do have an infrastructure advantage fund, which is, however, not very different from other infrastructure advantage fund. But if you want to look at as a complementary to the service fund, the infra advantage fund, hand in hand, would probably be almost a complete picture of the Indian economic growth story. So that's where I would put the...
Fair. Thanks a lot. Very, very interesting. Of course, the mid-cap fund, the services fund, and infrastructure fund are bang on in terms of some of the opportunity over the next 3 to 5 years. So what we'll do, we'll just quickly compile the questions, and a lot of them are coming in. Anulekha, in the interim, would you just want to give Sunil sir a break of 2-3 minutes, and then we get ready for the Q&A? Over to you, Anulekha.
Thank you, Sunil, for an amazing knowledge. I'll quickly introduce you all to our team. You've been speaking to them, and some of you even met them. So I'll start with Niyati. Can you just bring her?
Hello, everyone.
Can you just turn spotlight on her?
Yes.
Hello, everyone. Good morning.
Niyati is the pillar of our organization. She has an eagle eye on all your transactions and has phenomenal knowledge of all the processes. And now everybody who troubles Niyati by not approving the transactions, I want to know, please raise your hands. we want to know you. Then we have Mansi.
Hi, everyone. Good morning.
Mansi is the relationship manager with us. She's super quick, dynamic, and in true Gujarati style, keeps a hisab of all our outings. And if anyone needs a few tips in Teen Patti for next Diwali, surely contact Mansi. We have Bhavin Mirani.
Hello, everyone. Good morning.
Hi. Bhavin is the assistant manager, client experience with us. So when everyone gives up and has a problem, Bhavin will finally then come up with a solution. The foodie of our team, whom all we girls really like to trouble. And then we have Ayushi Wadhwa. She's the newest and youngest member of our team and works as a relationship manager. If you talk of mutual funds, PMS, AIF, she's at home talking about it to prospective and new clients. All the activity you're seeing on our LinkedIn page is thanks to her. When she's not talking finances, you can hear her at an open mic reciting shairis. So you know where to contact her. So we'll get on with the question and answer session now. Ayushi, could you start with the question?
We've received a few questions. Thank you, Mr. Sunil, for such an insightful session. Everybody is pouring with questions. So, are both of you ready to answer all the questions?
Yes, sure.
So the first question is from Mr. Ram. He's asking, we're seeing a good rally in pharma sector in the last couple of years, last couple of sessions. Is it sustainable? Are the fundamentals strong? Is it temporary? What are your thoughts on it?
So I think that pharma is essentially a bounce back rally, if I may say so. The reason is that, historically, pharma is perceived as a safe sector because people fall ill all the time, and there's demand for drugs and pharmaceuticals. It's not related to economic cycles, right? And so it was historically a safe sector into which you could bet on. In India, again, the labor advantage, which all are outsourcing of generics and all of that, had that space in the market. COVID changed that dynamic hugely because of the sudden spike in all your vaccines and hospitalization and related stuff and awareness of the thing. So I think that post that when COVID got controlled, right, it went through this period where it no longer was a fancy. So from a growth, it was again traversing back into a safety-oriented sector, right? So then what happened was that the money flow, which IT is a sector which has suffered similar to the pharma in that sense. So then what had happened is that the flow of money over the last 12, 18 months has gone into the manufacturing related space. And again, pharma, IT, all of them suffered the withdrawal of a broader liquidity into this space. And another space which got a lot of this liquidity was the banking space. Okay. Because of which, right, the pharma space actually did not get the money it deserved. And now the valuations in the manufacturing space, naturally, because everybody is talking, not just Sunil here, everybody is talking, or Amitabh is talking about the Indian manufacturing revolution. So what's there in the news is in the price, right? Everybody. So today, the infra space from a shorter term perspective is looking like it has had more money than in the short term it can deliver returns. Okay, it's just that way of the market. So that those who are now looking at it from a valuation perspective are looking to reallocate that capital away from a infra space because they feel, okay, now we have to wait for the numbers to come up and justify the prices. And that's where pharma is getting its share because, again, what's happened is that, one, again, it's like a standard, stable demand for drugs, one. Second aspect which has happened is what COVID did is made awareness of insurance, medical insurance for people. So the insurance sector's growth is coming automatically into the diagnostic space, into the domestic hospital. So when you say pharma, it's no longer just one export-oriented generic or an export-oriented product company, but now it's about hospitals, it's about diagnostic chains, and it's about medical tourism, where India is becoming this place where from African countries, Asian countries, people are coming to India for treatment. So it's now a much broader basket. And hence, there are pockets of opportunities here, which the market in its liquidity is seeking to find. So how far this is sustainable is the point is that like GDP numbers have come good. GDP numbers come and capex cycle is good. Somebody say, oh, that means my infra story has still more room. I'll put more money there. So it's a function of interstate liquidity within various sectors, right? But right now it's got to bounce back. It will probably traverse into a safety space where it will get its share of liquidity. But I don't see any strong triggers for a huge growth there because bear in mind the world is still going through a slowdown, right? So governments there who are in trouble will like to spend less on healthcare. Like in UK, nobody pays for healthcare; it's free from the government. But the UK government is in deep distress. So how much are they then going to allocate? So I wouldn't say there's a very strong growth story, but yes, one part of the China plus one story is in the space of the intermediate chemicals involved in the pharma process, where it's moving away from China to India. So within the pharma space, there are pockets like APIs where India is getting more space. There's also the fact that our research and PhD are actually becoming much better, and we're getting a much larger share of outsourcing by outside pharma companies in India. So it is a fairly well-developed story, but whether from a stock market perspective, it has the juice to deliver that extra returns from a medium term, I'm not yet sure. But as a safety component of a portfolio, it definitely has a place.
Right, fair. We have a few questions which are coming in also on my DM as well. So maybe Samarjit Ghosh has asked a couple of questions. Samarjit, you want to ask, or should I ask on your behalf?
Ask on my behalf, Vermaji. You do a better job.
Okay. He's asked two questions. One is in terms of on climate change and how does climate change affect the investment and where we should invest. And the other question was around government deficit and how, and as that share changes, is there something which we need to factor in investing? So these are the two questions on behalf of Samarjit.
Yeah, so both of these are very good questions because one is the growth aspect of that, right? Climate change is driving componental growth into, let's say, EVs, into solar, into nuclear power. So it is definitely driving the future direction of GDP of our country in terms of where the government's focus will be. So you can expect faster economic growth from those sectors because of the investment the government is making, because India wants clearly to be a leader of the alternative energy alliance of the world. That's one, right? The key point there from a market perspective, why I like this question, is because this move internationally, right? Because we have to be worried about who's going to buy stocks in our market and what stocks they are going to buy, the foreigners, right? So ESG as a framework, right? Globally, a few years ago, a lot of institutions, I talked about the pension funds and all of those sovereign wealth funds, they, as a part of their social, responsibility, right, said that we will incrementally start doing investment only in ESG related country, stock markets, companies, and the blah. And so pre-COVID, you saw this huge move. Lots of mutual funds launched ESG funds. Worldwide, there was this trend. And there was this thing that since that capital is going to preferentially look at this space, it will deliver better returns because there will be more money in demand. Unfortunately, COVID came and punctured that balloon. Because during COVID, right, energy prices dropped so low that fossil energy became so cheap that people forgot ESG and parked it in the backwaters and said money overtakes emotion, right? And so ESG funds haven't done as well and all of that. So the promise of ESG delivering better returns hasn't been lived up to. That's the current status. Now, what is the way forward, right? The way forward is, if the world is going to continue to go through a slowdown, you're going to see oil prices also trend down, because manufacturing and transportation are the two main requirements, right? The ESG story, right, I would say will take a little bit more time. When the world comes back on a growth path and Lloyd, let's say, gets 9,500 and it's expensive, and then people say alternate is the way of the future, then this balance will come. So if you're a long-term investor, then definitely there is value and wealth creation waiting to happen. But don't expect it that in the next 1, 2, 3 years, you will see that alpha generation coming from an investment in climate change. But longer term, definitely I see that the underlying forces of the government in India also driving the incremental change there. If you're a patient long-term investor, it's a very good allocation, but it will take time for the world to come back to growth before that can really start demonstrating. So that's on the climate change part. You talked about the fiscal deficit of the government, right? Now, it's important and not important. And again, I would point the blame on COVID. Pre-COVID, fiscal deficits were a very important part of everybody's life, because they said if you're printing money, you're creating inflation, then interest rates will go up, and ultimately the country's currency will depreciate, and hence it's a bad news if a country has. But COVID changed the dynamic, but every rating agency was forced to recognize that this is a time of populism, this is a time of saving the bottom of the pyramid people from dying, and so money needs to be put in. So the rating agencies as a whole took a very kind, and today the US is the largest fiscal deficit in the world, right? So India was also allowed. We were earlier talking about a growth to, declining growth of fiscal deficit to 2.5%, and we ended up during COVID with 6.9%. So no rating agency downgraded us. So the tolerance COVID has achieved is that the tolerance of the fiscal deficit has dramatically changed with the rating agency, because they decide the riskiness. A lot of institutions depend on the rating. That's number one. Number two is that a larger fiscal deficit is tolerated by later agencies if the money you're spending, right? What is deficit? Expenditure more than income. That expenditure is spent in future income generating assets. So if you're going to give it away through Narega, you're going to give it away through food and fertilizer subsidy, swaha, right? It goes in, any excess money goes straight to the Daru market, right? But if you're spending on infrastructure, you're creating jobs, you're creating factories, which are going to future lead to GDP growth, future GST income growth, income tax growth from corporate as well as personal taxes. So that future fiscal deficit will come down. So that's where the government of India has made a very significant change right from 2014, where the component of the expenditure has sharply diverted in favor of capex, which has a multiplier effect. So it is said, and I read a study here, that 1 rupee spent on capital expenditure lasts for 16 quarters in the economy. 1 rupee spent on revenue expenditure lasts for hardly 3 to 4 quarters. So that's where I think the Modi government has been smart, and whether Nirmala gets credit for it or Modi himself gets credit for it, that they have done a very good job of actually spending on infrastructure, which means in budget after budget, the announcement has resulted in the actual also turning out that way. It's not promise and not deliver. And it is already showing results that our GST collections are going on month up, which means that multiplier effect is actually playing in action. So I believe that even this year, so far, the data which came out yesterday showed that our fiscal deficit was 45% of the year's fiscal deficit. So with the half year gone, it should be 50%. It's only 45, which means that income generation for the government has been faster than expenditure. And so I don't see a worry on account of, yes, we won't reach those 2.5 levels. We promise we'll be close to that. And the tolerance will be there as long as the government sticks to the expenditure composition being around infra. So I would see that as a cause for worry. As far as India is concerned, world at large, it's a different story. The US government has had to buy from the Congress time till 2025 to tolerate their expenditure budget. So they are all not in a similar state as us. We have a lot of wiggle room on the fiscal deficit as long as we are spending on the right thing. So I think not a worry or a concern from a foreign investor looking at India, because ultimately that's what matters for the stock market.
Fair, thanks.
Thank you, Sunil sir. Just one question, Sunil sir, on the climate change. The climate change, will it affect food grade production? And if it is food grade production, does it open up new opportunities for the market?
So I think that India, as far as food grain production, definitely the El Nino and other effects will impact it. But I think what it will do is something the government has failed to do due to populist sentiments, which is to modernize agriculture. Our productivity level in agriculture are woeful compared to the rest of the world. So they tried the farm law moderation and they were forced to pull it back because of the opposition. The very short-sighted move by the opposition on that, we had to pull back. But if El Nino type of situation comes in, climate change and food production gets affected, then the hands of the governments will be forced into mechanization, productivity improvement, and all of that. And who knows, that may be a blessing in disguise, because the huge amount of land which is allocated into agriculture is not actually delivering the value for a country it should, right? So I think that short term there would be an impact, but long term it will drive the fundamental reform needed for a country like India, because the large land mass allocated to agriculture is not pulling its weight.
Thank you, sir.
Thank you for your answer. We have two questions. They're more or less similar, so I'll club them into one. So recent inflows have been majorly towards mid cap and small caps. When do we expect the large caps to start performing? And how do FIIs and other large investors decide upon the large, mid, and small caps? How does this impact the changing role of retail investors? And how can a small retail investor predict such a trend? Too long question.
So let me answer the last question. Last question first, the last part. No way you can predict it.
Yeah, easiest question.
That's the easiest part. Okay. The second aspect here, I would say, is that there's a lot of hype around fund managers sitting and deciding how much in large, how much in mid, how much in small. I think it is overstated, right? Because if you look at the fact that larger investors from outside of India, when they invest in a risky country like India, but let's bear in mind, for all of our growth, for all of everything, India is the part of the emerging market. India is heavily dependent on just one commodity, oil. So we are on the risk framework pretty high for a foreign investor. Let's bear that in mind. So when you enter into a risky space, you seek safety. So if you see historically, why has IT been long-term earlier a good performer? Because when they come into a risky market like India, they want safety. And why is IT a safety? Because they know the IT company is supplying to that company in America. Who's buying from the IT company, he can understand very well what its growth pattern is, everything. So you seek safety. That's why foreign investors are largely invested in the large cap space, right? Otherwise, they would love to invest in small and mid caps, but they're too scared of the volatility, the lack of corporate governance, the lack of transparency, the lack of free flow. These carry away them, right? Because short moves can make big damage to their portfolio. So, but of late, I must notice that investors from Japan, FIIs, have been increasingly participating in our mid-cap stocks. I see that as a trend. So as the world gets greater comfort around this, I see them entering into the mid caps, but small caps are still a far cry from that. That's one from the foreign perspective. Domestic investors, right? Who are they? They have insurance companies. Now, insurance companies by mandate can only put in large caps, large amount of their money, because they are a 10-year, 15-year, and safety is key. Similarly, the institutional allocation to equities by Provident Fund, by NPS, all of that is largely in the large cap, in the passive space, because for them, the volatility is not something that they can afford to take, right? So their hands are tied by that. So it's not they sit and say, now large caps are overvalued, undervalued. That's what I meant, right? So now you take out these two buckets, right? So large FIIs and large DIIs, right? So that leaves then only the domestic mutual funds, portfolio management schemes, AIFs, and then retail investors as deciding that I buy this stock or that stock or whatever the flexibility. Now there, if you made the statement that there's been a sharp increase in flows in the small and mid cap. Yes. What has happened? Just 2 years ago, 2021 April, we had 50 lakh folios in small cap. Today we have 1.3 crore folios in small cap. 2.5 times the investors, new investors have been introduced into small caps, right? So it is a bit scary when you look at it from that number. But the flip side to that is that the large part of the growth in the SIP book has been on the lines of the small cap and mid cap. So the good thing that most advisors have done is introduce these people into small and mid caps through the SIP route. That does two things, right? So first thing it does is, from that investor's perspective, it's helping him average out the cost of acquisition. It's called rupee cost averaging. But from a fund manager who's getting the flows, it gives him the buying power every month. So actually speaking, because of the way this SIP book has contributed to, see, today the estimate is about 35% of the mutual fund AUM is from SIPs. Okay. So that has helped to provide what I call as a shock absorber. I mentioned this some time back into the flows. So what has happened is that these fund managers are able to, and they cannot take that small cap SIP and put it in large cap. That's why I said it is, people are saying the fund manager will decide. No, the advisor combined with the investor has given the money in small cap. He has to buy small cap. So it's not that a fund manager is sitting and saying, now this valuation is high, that valuation. This is a trend of valuations. Last month, from September onwards, valuations small and mid cap are higher than large cap. Still more and more, it's going up only the valuation, right? Then one final point here is that where the fund managers have a limited discretion is in flexi cap, large and mid cap, multi cap, those kind of funds, right? Focus funds, where they can actually take a call. And that's the only place where it happens. And that's where the immediate reactions happen. So what happens, for example, if we saw this in the month of April, FIS till Jan, Feb, March had pulled out 30,000 crores from Indian market. April, May, June this year, they brought in 1 lakh crore into the market. Now, as far as the domestic fund manager, nothing had changed in India. Our growth rate was around 6 to 7%. It was continuing at 6 to 7%. Nothing changed. These FIs suddenly changed. Why? Because oil prices started declining. But that 100,000 crores came largely into large caps. So large cap valuation shot up. So when a domestic fund manager had the discretion, at that time in these kind of funds, I did a study of this. I saw that they had all allocated more to mid and small caps within these flexi cap kind of funds. And hence what happened was, large caps didn't rally because for every seller there was every buyer from the FII, there is a seller from the mutual fund. So large caps haven't rallied because there is enough stock, and that has got diverted into small caps and mid caps. And so 1 rupee moving away from large cap may cause a 1 or 2% drop in price of a large cap. That 1 rupee will cost a 3 times rise in a mid cap price and a 5 to 10 times rise in a small cap price. So same liquidity moving across the cap curve causes huge difference in returns. So this reason for small and mid caps to deliver those returns is step one, the fund managers reallocating these proportions away from large caps to mid and small cap. Second, I said Japanese FIs coming a little more into mid caps. And third, then retail investors following the return path. We talked about fear and greed right at the beginning, right? So this greed, looking at the small cap returns, everybody said, I want to be in the small cap gravy train, right? And luckily, because it's come through SIP, that gravy train hasn't broken down. It's still going on, right? But now when you look at the situation, September and October, when the FII sold, right? Initially, you saw a correction in small and mid caps because the same fund managers started buying those large caps because FIs were selling, the valuations came down, they started buying. But from November, again, FII money has started coming in. So now again, the fund managers will look at expensive large caps versus mid and small caps. So some reallocation, the continuing SIP book. So I don't see that in the next 3 to 4 months. I don't see a risk to the small cap journey. Maybe 3-4 months down the line, when the valuations are shot up even more, then there's a time when some fund managers will sit and look at it. You will see small cap funds saying, no more money, I will not take any more money, because then that element will sit. I think we're still a few months away from it. But I would, from an investor perspective, I would urge you to exercise caution around increasing allocation to small cap, because it could last for a few more months, this gravy train. But sometime or the other, that difference will come in and have an impact. That's number one. Number two, if at all you do that, stick to doing it through an SIP format, right? So where you stagger it over a period of time, right? So and the third aspect is, now that the FIs have started coming back, I think large cap returns will also start looking better in the coming 2-3 months, because one of the key elements of the large cap which hasn't performed well is the FMCG segment. But in an election season, as more money gets spent in the economy, consumption tends to go up and those numbers look better. Then FMCG also will start getting more allocations from it. So I do expect that large caps will bounce back in terms of returns because of the FII flow coming in. So I would expect a more balanced differential between large and middle will not be that great in the coming few months. There will be a narrowing of that difference.
Great. That actually answers a few more questions which were asked. And Nitish had asked a question around what is a good time to enter and exit. I think that's got partially answered here. So I'll move out from that train of, because I'm also cognizant of the time. So there's a question from Shonak, and Shonak, you may want to ask, or if you want me to ask, whichever way, you can mute and ask.
You go ahead.
Okay. So the question was in terms of that in the last 10 years, Indian market has grown about 212%, but Indian currency fell 37%. While in contrast, US markets in the last decade grew to 65%. The next decade may be different, but the last decade. So why do US and Canadian funds come to India? Is it, and despite the currency fall? So
I think that, see, the longer term story around currency, every fund manager, either it's short term or medium term or long term, has got currency computation as a part of his dynamic model, which he has, right? So when you then do that, currency behaves just like stocks and like commodities, right? There is a fundamental element to it, and then there's a demand and supply element. And nobody can predict demand and supply in a 3-year, 5-year, 10-year, what's going to be the demand and supply. So you will have to bet your bets on the fundamental analysis and stick to that. Just like a long-term stock market mutual fund investor looks at the discounted cash flow, EPS, and buys it based on that. He says ultimately market flows will respect that growth, right? So currency, the fundamental factor which drives currency between Canada and India or US and India is actually, on the fundamental basis, is the difference in inflation. But the problem is that it's hard to compare same commodities, because each country's inflation is a different basket. So the banking system, which essentially there's trillions of dollars everyday trade going into currency, right? The banking system has adopted something as called as the interest rate parity model, which is that the difference between the two countries' interest rate. Now, what interest rate you take? Obviously, there's a risk of default when you're borrowing or lending, right? So they choose the government. They assume, here again, that governments don't default. Now, again, that's not true. Cases like Argentina and all that have defaulted. But broadly, market has to rely on something to go forward. Otherwise, it'll never go forward. So they take it that government is default free, and they take the longer term government yield because, that's more stable. So then when you look at it, right, the difference in interest rates between the Canadian government or the US government and Indian government generally is the fundamental calculation, right? Today, that difference is 3%. US is at 4.5%, 10-year yield. India is at 7.5%. But historically, it was at different points in time different, right? Because even in this rate hike, US has raised rates by 250 basis. So when you look at it, these people factored in let's say 3.5% depreciation into their calculation. And I think our stock market on a post depreciation basis has delivered better returns than that. And that's why they are happy that that has happened. Sometimes they've actually gained because currency was strengthened in the short term. When FI first came in strongly, Indian currency didn't depreciate. At those points in time, they actually made much more money. So they take a fundamental 3, 3.5, 4, depending on their starting point. as a depreciation between two countries. Say that I will take this loss from India. Can India grow beyond that? And I think if you take India's growth, right, let's take nominal GDP is something that the stock market respects. Over a 15-year period, any country in the world, right? I mean, leave the developed countries, China, South Korea, India, the stock market capitalization has grown better than the nominal GDP growth of the country, right? For India, that's about 8.5%, and the stock market growth was around 9.6%. So now when you look at it, right, I'm looking at a foreign investor now, the next 10 years, he will, let's take 6% as a comfortable margin of safety on Indian GDP growth, and let's take 5 to 6% as a nominal GDP growth in rupee terms. Now take a 3% depreciation out of that, right? That means that post that he will get a 9% return from India from a nominal GDP capital market correlation, whereas today even the US Treasury is giving him only 5% risk-free. So there's a 4% premium for him, which is called the equity market premium or the capital market premium over a risk-free asset for him, which is getting. So feels that with India's growth being fairly on a certain glide path, he says 4% alpha I'm getting from India on a dollar basis is good enough. That's why they choose to invest in countries like India.
Yeah, that's an excellent answer looking at the alpha. I mean, but real returns over a 10-year period, I mean, on dollar terms in Indian market has been 5% compounded, whereas like on the US side of the market, that's more like 12 to 13% compounded. So, I mean, I did not think about the alpha part of the short term. So good answer, doctor. I mean, this is Sunil.
Thanks a lot. So one question I have, Shailesh Rajadik asked, so I'll rephrase it and ask in terms of, so somebody who's looking at 5 to 10 years pre-retirement and looking at building a corpus at that point of time, what are the avenues and what should one be looking at?
So how old is he right now?
58.
He's 58.
58,
right?
58.
58. Okay. So
Yeah.
when you say retirement corpus, how far away are you looking at having a corpus where you will stop earning from your regular activities, whatever you're doing?
So he's looking at 7 10 years.
He's going to work for another 7-10 years?
Yeah.
Yes.
Okay. So let me put it this way, right? You're talking about, let me say, at the age of, let's say, 65, you want to basically live off what you've already earned and not be earning more from your regular work. And if you can assume the average life expectancy in India and the fact that that's about 72 plus years, but that's again because the poor are probably at 45, 50 and the rich are 85, 90. Let's take 90 for you. So which means you need money for 25 years to last for you. Okay. So for 25 years, I would say how much you need to build a corpus. A very simple thumb rule, I'm sure Amitabh and others will help you guide this here, is to assume that, right, your standard of life from your current standard, you don't want to drop it, right? So I would say that 300 times that is what you should have on your monthly expenditure, right? Why do I say that? Is that basically to look at it that you should look, ideally to me, the most tax efficient way to plan for this is to get that corpus and take 4% out every year, which means 0.33% per month. Why do I say this? That at 4%, assume zero capital growth of your investment, the money will last 25 years. So you have no reason to worry that you'll run out of money. And 4% growth, right, is something where that means you withdraw 4% through what is called as a systematic withdrawal plan, right? Take it out. Now, sometimes the market will correct and you will be taking out your capital. But more often than not, if India is going to go at nominal GDP, 12% if your assets grow in equities, you're going to have 8% surplus, which is staying in the market. So you will definitely be left with a very healthy corpus, even at the age of 90, to leave to your children and your grandchildren, to bequeath it to them. So it's not just you got to look beyond your lifetime to what you want to leave for them, right? Now, on that basis, if you look at it, so from whatever corpus you have, right, over the next 7 years, and if you take the rule of 72, right, doubling it is 72 divided by the number of years. So 72 by 7 means 10%. right? So if you think that, I don't want to get into the nitty-gritties, Amitabh and others will help you, right? If you think that double of what you have today is good enough for that calculation, then I think the equity market is a safe space to expect a 10% return on your assets. So at this age, normally people say 100 minus 8 should be in equities. I believe that is bunkum, because those rules have changed because of life expectancy and everything. So to me, right, you can allocate 70% of your corpus into equities, and the balance 25%, I would suggest you put it into the hybrid category, because the stock market's volatility, right? Why I'm saying this is that 25% is what will make sure that your overall 4% at least gets done. Right? So the hybrids, which are typically 65-70% equity, 25-30% either in gold or through multi-asset funds or in fixed income instruments, provides you the shock absorber to make sure that, we don't see that in the next 7 years stock market is going to a bearish phase, but assume there is a high volatile phase in the market. These hybrid funds should help cushion the impact and not make you feel, oh, I'm bleeding capital every month and living out of my capital, because mentally you got to tackle that. Right? Emotionally, we're all emotional human beings, right? So I would say roughly a 70% into equities and 30% to hybrids should take care of this thing. And equity-oriented hybrids help you to also defer the tax, right? Because unfortunately, the finance minister took away pure debt funds taxation, so it's no longer that attractive as an instrument. So equity-oriented hybrid funds, right? And there's a range of equity they do, because arbitrage is a very effectively used asset by fund managers to reduce actual equity component without giving up taxation. So I'm sure Amitabh and others could guide you to the range of hybrid funds in the market.
Right, absolutely.
But I think broadly, I think this should do.
So on retirement, we have done a lot of work, and Shailesh, and we'll separately connect with you, and we have a lot of models which we have built in, simplified ones, and we'll run you through that. I'm absolutely cognizant of the time. So what we are going to do, one final question, and then we'll close the session. There are more questions coming in. So separately, we will try and take that on board and address that. And Sunil, I think the fact that we have overshot our time and questions are pouring in is testimony to the popularity that you have. Ayushi, the last question, absolutely last question.
So
I think Vikram has
Mr.
Yeah, Anulekha, sorry, Anulekha. Yeah.
Okay, Ayushi, go ahead.
Yeah, this question is from Mr. Vikram Iyengar. So if we are in a similar cycle as China was a decade ago, when do you see a downturn in the growth story? After all, population inversion is already happening, and our young population of today will be the largest aging population in a couple of decades. Additionally, we've spoken about all the positives. What is the biggest risk to the markets in the short and medium term, apart from global oil cues?
Okay, the first thing is that, so while I talked about replicating the China story, let's face it that China is an authoritarian government. We are a democracy. So our estimate is that what China did in 4 years, will take 9 years to do. So that is a positive and a negative, because yes, it's going to take longer to do. So we probably won't hit double-digit GDP growth that fast and all of that. But paradoxically, that's what will stretch out this, because we're not going through boom bust. We're not going through huge double-digit growth and then collapse to China. That's number one. Number two, you mentioned about the fact that we are also aging. So according to us, at least for the next 2 decades, right, we will remain the youngest country in the world. After 2 decades, what happens, how we handle the situation, I think as a looking glass is just too far ahead for us to really, because lots of things could happen in the world. You could have World War IV, which will come and alter the dynamics. You could have, I think that if you have a 2-decade outlook for something, I think looking beyond 2 decades is too much of storytelling. It's too much of fortune predictions, right? I don't think anybody has a model which says what happens at the tail end after 20 years. So honestly, I don't have an answer. So to come back to the answer, I don't have an answer as to India going through a slowdown after 20 years. The world itself, in what situation it will be, we don't know, right? And we will be, hopefully, if we succeed, we'll be a developed country by then. So we will then face all the problems of a developed country, like aging population, forcing to take care of the medical, and non-contributing dependency ratio will go up. So clearly, every country goes through this cycle, but I see that 2 decades is long enough for us not to factor that into computations today. That's my answer. Will we go through a slowdown phase? Absolutely. The world is cyclical. What goes up must come down is a law of the land, because always you have never seen. You see, India was the world leader in the Gupta age, right? And then Britain was the world leader 100 years ago. So everybody goes through this phase, right? Spain at one time was conquering the world. So I think to say that India will always be on a high is not fair. So yes, 2 decades later, will India go into slowdown? Yes. But what do we do? Maybe we go something like Japan. Japan went through 2 decades of no equity market growth, because that's what the aging population did to them. So that could be the story for India. But I'm just saying it's so far ahead in the future, right? That we would be, I think putting that element into our computations would distort the picture too much. So I would say at this point, it's better to focus on the next 2 decades rather than what after 2 decades, right? The other question you asked me was about the risks other than the global oil prices. And I think the biggest risk to our country is civil war. And what do I mean by that? Why civil war? Civil war because we have not succeeded in providing enough employment opportunities, which the demographic dividend is telling us as a positive, is also could be our biggest negative. If you don't provide jobs, then an idle brain is the devil's workshop. You will have agitations over everything. There'll be mobs, streets, fights, because when large population is going without food, then everything else dominates. So I think that is the biggest risk, which the government has a lot of announcements, but practically on the ground, apart from the little bit of success of Agniveer, even that went through so much opposition. The government cannot be the employer, right? Private sector, that's why this PLI, these teams have to succeed. So the world goes through an extended slowdown, then our manufacturing capacities cannot be put to use. See, we cannot grow just by substituting China. We have to grow as part of an expanding world. So I do hope that the world comes fast out of this slowdown. So an extended 5 to 7 year world slowdown would mean that even with PLI, even with everything, we won't be able to create enough jobs. So there'll be so many educated, unemployed roaming. They will be educated, so they will be more prone to illogical causes to support, come on the streets, burn. So I think that's the biggest risk to me. It's civil unrest in our country. Apart from that, I think if we grow, right, I don't think we can afford to continue to be 83% dependent on oil. So it's not just global oil prices. We have to move to a less, and to be fair, the government, more than 50% of the capacity creation is in alternative energy. And the government is planned for a 35% by the end of the decade of our total energy coming from alternative energy. But the failure of that program, a delay in that program, leave alone the oil prices movement. It is a fact that India has to, as a growing country, because 6% GDP growth or 12% nominal GDP growth, which means we are going to be 120% of our economy size in 10 years from now. And 83% of that much of oil is humongous, right? The world will be producing oil only for India. We cannot afford to do that. So apart from the oil price dynamic, as a country, we have to consciously reduce our dependence on fossil fuel. I think that is the biggest risk, that if we don't succeed along those paths, then we will single-handedly make oil prices remain high in the world. So forget about oil prices reflecting India. India will be deciding the oil price because of its sheer demand. So that is the risk. So oil in a different context is the biggest risk for our country also.
Fair. Great. And I think with that, we'll pause the questions. We'll try and address some of the questions which we have received separately. Thanks a lot, Sunil, for your time. I know you have, today is a Saturday and you have lots of other things on your agenda, and we have already extended you. But I think it's very useful, very interesting to hear your perspective. There are a lot of questions answered. There's a lot of context and background given, which I think all of us have read it in many places, putting it together in terms of a financial market, in terms of how that would shape the economy. Of course, all of us are invested in India, in the India growth story. And all of us are very cognizant of how do we manage both the short, medium, and long term. But I think the biggest comfort which we draw from this, that the factors driving the growth of the market is something which looks steady and stable for a long period of time, short-term volatility notwithstanding. And I think as we plan the retirement, we had discussed a little bit on that. We covered a little bit on various aspects. All of them, as long as things are supportive, it's actually a lot more predictable, stable, and manageable. And we definitely thank you for your time.